silver just shocked the market. One moment it was breaking levels many thought were impossible in the near term. Headlines everywhere were screaming record highs. Social media was flooded with bullish predictions, and then suddenly the price pulled back. Not a crash, not a collapse, but enough of a move to make people ask a dangerous question. Is silver done? Or is this just the market catching its breath? Because here's the truth most people miss. Markets don't move in straight lines, especially not silver. To understand today's silver market, you have to stop looking at the price alone and start looking at what's happening underneath the surface. Silver didn't rise by accident. Over the past few weeks, silver entered what traders call a momentum phase. That's when price moves faster than fundamentals. Not because fundamentals disappear, but because they stack on top of each other. Inflation expectations didn't vanish. Central banks didn't suddenly become hawkish. Industrial demand didn't slow down. In fact, all of those forces were already in place. What changed was psychology. As silver pushed higher, it crossed technical levels that had acted as resistance for years. Each breakout pulled in a new group of buyers, first long-term investors, then trend followers, then short-term traders, and finally late retail buyers who saw only one thing, the price going up. That's when the market became crowded. And crowded markets behave differently. When everyone is leaning in the same direction, even a small trigger can cause a pause. Not because the story is broken, but because the market needs liquidity. It needs sellers to keep moving higher, and the only way sellers appear in a strong rally is through profit-taking. This is exactly what we saw. Large players, funds, institutions, traders who bought silver much lower started locking in profits. Not because they believe silver is over, but because risk management demands it. When price moves too far, too fast, the smartest money reduces exposure. That selling doesn't mean fear, it means discipline. And when that selling hits a market full of leveraged positions, something predictable happens. Stops get triggered. Short-term traders rush for the exit. Price pulls back faster than it rose. To someone watching the chart without context, it feels alarming. To someone who understands market structure, it feels normal. Silver is one of the most volatile major assets in the world. It always has been. Historically, silver overshoots in both directions. It rallies harder than gold, and it corrects harder than gold. That's not a flaw. It's its nature. But volatility doesn't equal weakness. In fact, today's pullback happened while something very important stayed intact, the broader macro narrative. Interest rates are still high relative to slowing growth. Governments are still running massive deficits. Currency purchasing power continues to erode quietly. Industrial demand for silver, especially in energy, electronics, and infrastructure, hasn't disappeared. None of the long-term reasons people own silver changed today. What changed was positioning. When silver hit those highs, positioning became extreme. Futures markets showed crowded long trades. ETF inflows had surged. Sentiment indicators were flashing optimism. That's when markets usually pause. Not end, pause. Think of it like this. A runner sprinting uphill doesn't stop because the destination disappeared. He slows down because his body needs oxygen. The market works the same way. Today's pullback was the market taking oxygen. Another factor most people ignore is the role of the US dollar. Silver doesn't trade in isolation. When the dollar strengthens even briefly, precious metals often pull back. Today, the dollar found short-term support. That added pressure on silver prices. Again, not a reversal, a countermove. This is where inexperienced investors make mistakes. They see red candles and assume the story has changed. They panic sell at the worst moment, right when volatility spikes and liquidity dries up. Experienced investors ask a different question. They ask whether support levels are holding. They ask whether macro drivers remain intact. They ask whether the pullback is shallow or structural. So far, this pullback looks technical, not fundamental. Silver didn't collapse through long-term support. It didn't break trend structure. It didn't invalidate the broader move. It simply retraced after a powerful rally. And historically, these moments often decide the next big leg. Because markets don't punish optimism, they punish certainty. When everyone becomes certain that silver can only go up, the market reminds them that risk exists. And once fear replaces greed, the strongest hands start accumulating again. That's how trends continue. But here's where it gets more interesting. This silver rally didn't come from retail traders alone. It came from a combination of macro fear and industrial reality. Silver isn't just a monetary metal like gold. It's also a critical industrial input. That dual role creates tension and opportunity. On one side, you have investors seeking protection against currency debasement. On the other side, you have industries that need silver regardless of price. When those two forces collide, price movements become violent. Today's pullback doesn't erase that tension, it highlights it. And that brings us to the real question going forward. Not whether silver pulled back today, but whether the market is preparing for something bigger. Because historically, the most powerful silver moves come after corrections that shake out weak hands. So the move you're seeing today might feel like a warning. but it could just as easily be the setup. If you really want to understand what silver is doing right now, you have to stop thinking like a trader watching 5-minute candles and start thinking like capital. Because markets don't move on emotions alone. They move on positioning, incentives, and constraints. And right now, silver is sitting at a very interesting intersection of all three. After the pullback, the first thing serious investors look at is not the headline price. Where selling pressure actually came from. Was it panic selling? Was it forced liquidation? Or was it controlled profit taking? So far, the evidence points to something important. This was not fear. When fear hits a market, liquidity vanishes, spreads widen aggressively, correlations break down. You see disorder. That's not what silver showed. What we saw instead was orderly selling. Volume increased, yes, but it wasn't chaotic. Price moved quickly, but it respected structure. That tells us something critical. The people selling silver right now are not abandoning the trade. They're managing it. Large funds don't think in days or weeks. They think in quarters and cycles. When silver ran hard, they reduced exposure. Not because the thesis failed, but because concentration risk increased. When price pulls back into zones where risk-reward improves again, they re-enter. That's how institutional money operates. Now let's talk about those zones. Every strong trend has levels where buyers previously stepped in aggressively. Those areas become memory points for the market. When price returns there, participants ask themselves a simple question. Does this level still matter? In silver's case, the pullback so far has not violated any major long-term support zones. We haven't seen a breakdown that would suggest distribution. We've seen a retracement, a reset, and resets are healthy. Another key signal is what hasn't happened. Silver hasn't seen a surge in short interest betting on a collapse. That's important. When markets top, short sellers usually smell blood. They step in aggressively. So far, that behavior is muted. That suggests skepticism, not conviction, and skepticism fuels trends. It's part of a broader macro environment that is still deeply unstable. Monetary authorities are trapped between inflation and slowing growth. This creates a situation where real assets remain relevant, even if inflation numbers soften temporarily. The structural drivers haven't disappeared. Productivity growth remains weak. Demographics are unfavorable. Energy transition requires massive material input: solar panels, electric vehicles, electronics, infrastructure. That's why silver behaves differently from purely financial assets. You can sell a stock and walk away. It doesn't prevent volatility, but it limits long-term downside. When confidence in currencies erodes, silver benefits. That dual personality is why silver frustrates people. Now consider the current investor landscape, some through futures, some through physical purchases. Many of them are not experienced with silver's behavior. So when volatility spikes, weak hands exit. This is not theory. This is how silver has behaved historically for decades. And that's where patience becomes a competitive advantage. Silver futures markets tend to attract leverage because of silver's volatility. That leverage amplifies both gains and losses. When price pulls back, leveraged positions are forced to unwind faster than unleveraged ones. That forced selling exaggerates moves. But once that leverage is flushed out, the market becomes healthier. The release looks dramatic, but it prevents catastrophic failure later. Markets don't reward consensus. When everyone agrees that silver is going higher, the market creates doubt. When doubt grows, weak holders sell. When fear peaks, the next leg often begins. Right now, we're in that uncomfortable middle zone. Not euphoria, not panic, uncertainty. And uncertainty is fertile ground for accumulation. The most dangerous mistake investors make is confusing volatility with risk. Volatility is visible. Risk is structural. The structural risks that supported silver's rise, currency debasement, fiscal instability, industrial demand, remain in place. What changed is sentiment, and sentiment can change back quickly. This doesn't mean silver must immediately rally again. Markets can consolidate, they can chop sideways, they can test patience. But consolidation above prior resistance is not bearish, it's constructive. What matters next is not today's candle, but how the market behaves when it revisits key levels. Does buying return? Does volume support price? Does selling dry up? Those answers will tell us far more than headlines. So when you hear people say silver is over, ask them one question. What changed fundamentally? So far, the answer is very little. And that's why this pullback deserves attention, not fear. Because in markets, the most important moves often begin when the noise is loud and clarity is low. And in the final part, we're going to look ahead. We'll talk about scenarios, not predictions, not hype. Realistic paths the silver market could take from here, and what signals would confirm or invalidate each one. Because understanding risk isn't about certainty, it's about preparation. Now let's talk about what actually matters from here. Not predictions, not hype, but realistic paths the silver market could take, and how to think about them without emotion. Because the future of silver won't be decided by today's headlines. It will be decided by how the market behaves after the noise fades. There are moments in every market where uncertainty creates opportunity, but only for those who understand the difference between a pause and a reversal. Silver is at one of those moments. The first possible path is consolidation. This is the most boring outcome, and ironically, the healthiest. Price moves sideways. Volatility compresses. The market digests the gains from the recent rally. Weak hands exit. Stronger hands accumulate quietly. In this scenario, silver doesn't collapse, but it doesn't explode either. It holds above key long-term levels and slowly rebuilds energy. Sentiment cools. Media attention fades. That's usually when foundations are laid. Most bull markets spend more time consolidating than trending. But people remember only the breakouts. And the second path is deeper retracement. This is the one that scares people the most. Price pulls back further than expected. Support is tested. Headlines turn negative. Commentators declare the rally over. Late buyers panic. This is where conviction is tested. But a deeper pullback does not automatically mean the trend is broken. In fact, silver has historically retraced significant portions of its rallies before moving higher. These pullbacks feel violent because silver is volatile by nature. What matters here is not how deep the pullback goes, but how the market responds when it gets there. If selling pressure exhausts itself and buying interest reappears, the structure remains intact. The third path is immediate continuation. This is what optimists hope for and what markets rarely give cleanly. In this scenario, the pullback ends quickly. Buyers step in aggressively. Price reclaims recent highs. Momentum returns. The market surprises skeptics. This usually happens when macro catalysts reassert themselves faster than expected. A sudden shift in interest rate expectations, currency weakness, geopolitical stress, or supply shock. This path is possible, but it's the least predictable. What all three paths have in common is something important. None of them require the silver story to be broken. They require patience. One of the biggest mistakes investors make is assuming that price movement must immediately validate their position. Markets don't operate on our timelines. They operate on their own internal dynamics. Silver is not a technology stock. It's not driven by quarterly earnings. It's driven by long-term structural forces that unfold unevenly. That's why short-term volatility can coexist with long-term strength. Another thing to remember is relative value. Silver doesn't trade in a vacuum. It trades relative to gold, relative to equities, relative to bonds, relative to currencies. When those relationships shift, silver responds. If gold holds strength while silver consolidates, that's not bearish. It's typical. Silver often lags before outperforming. If equities struggle while silver stabilizes, that tells a story. If bond yields fall and silver doesn't respond, that's information too. Markets communicate through relationships, not isolated prices. And then there's the issue of supply. Silver supply growth is limited. Mining is capital intensive. New production takes years. Recycling can increase supply marginally, but not enough to offset structural demand shifts quickly. This doesn't mean silver must rise in a straight line, but it does mean that sustained demand eventually expresses itself through price, and demand is not just investor-driven. Industrial demand is less sensitive to price in the short term. Manufacturers don't stop using silver because it's volatile. They adjust margins. They pass on costs. They secure supply. That creates a baseline. Above that baseline sits investment demand, the most emotional component of the market. That's what creates spikes and crashes. But it's also what creates opportunity for those who can separate emotion from structure. Right now, emotion is elevated. Some people are euphoric. Some people are fearful. Both extremes are dangerous. The market rarely rewards either. What it rewards is discipline. Understanding where silver sits in the broader macro cycle matters more than guessing tomorrow's price. Understanding risk matters more than chasing momentum. Silver's recent pullback is not a verdict. It's a test of patience, a test of conviction, a test of understanding. And tests are uncomfortable by design, so the question isn't whether silver will go up or down tomorrow. The question is whether the conditions that brought silver here still exist. So far, they do. That doesn't guarantee anything. Markets owe no uncertainty. But it provides a framework, and frameworks matter. Because without one, every price move feels like chaos. With one, volatility becomes information. Silver is telling a story right now, not through headlines, not through hype, but through behavior. It surged when conditions aligned. It pulled back when positioning became crowded. It's now searching for balance. What happens next will depend not on hope, but on how capital responds. And that response will be visible, not instantly, but over time. For those willing to watch carefully, this moment matters, because markets often reveal their intentions not at the top, but after the first pullback. And silver has just had its first real pullback. What comes after is where the real story begins.